The dynamics of the global financial system have undergone significant transformations over the past few decades, with central banks and precious metals playing pivotal roles in these shifts. Around 2009, a notable change occurred in central bank behavior. They transitioned from being net sellers of gold to becoming net buyers. This transition was not coincidental. It coincided with the aftermath of the great financial crisis of 2008-2009. The financial instability of that period highlighted systemic vulnerabilities, prompting central banks to reevaluate their reliance on fiat currencies and their reserves. The accumulation of gold reflected a loss of faith in the financial system, which central banks themselves had largely shaped but seemed unable to fully stabilize. Their actions signaled the need for a more secure foundation, showcasing the enduring value of gold as a safe haven asset. Observing this trend, individuals and investors alike might draw the conclusion that emulating central banks by incorporating gold into their own financial strategies could be a prudent step toward financial resilience. This growing emphasis on gold was further fueled by a broader sense of unease about the durability of the banking system. Many analysts believe that banking crises are far from over, and central banks seem to agree, evidenced by their ongoing accumulation of gold reserves. This accumulation may also reflect anticipation of a broader monetary reset, a potential shift in the global financial architecture. Such concerns highlight the need for preparedness. While it may be disheartening to consider the economic turmoil that often drives gold prices upward, it is nonetheless essential to position oneself to benefit from these trends rather than be caught off guard. The role as a stabilizing asset is not just theoretical. It is a lesson drawn from the actions of institutions with the most at stake in maintaining financial order. Turning to silver, another critical player in the precious metals market, its dual identity as both an industrial and monetary metal sets it apart from gold. Unlike gold, where industrial demand constitutes only about 8-10% of its market, silver's market is evenly split between industrial and investment demand. This unique balance gives silver a rising floor in terms of value, as industrial demand provides consistent support. At the same time, investment demand introduces volatility, significant price spikes during periods of heightened interest. One of the most insightful tools for understanding the relationship between gold and silver is the gold to silver ratio. This ratio, calculated by dividing the price of gold by the price of silver, provides a measure of how many ounces of silver are needed to buy an ounce of gold. Historically, this ratio has averaged between 55 and 60 over the past 2 decades. However, when the ratio climbs above 80 and then begins to decline, it often signals a strong buying opportunity for silver. In these conditions, both gold and silver typically perform well, but silver tends to outperform due to its lower base price and higher volatility. Such patterns are crucial for investors seeking to maximize returns during precious metals bull markets. To explore silver's potential, it is instructive to look at historical precedents. In the late 1970s and early 1980s, during a major bull market for precious metals, gold reached a peak price of around $850 per ounce, while silver hit approximately $50 per ounce. This resulted in a gold to silver ratio of about 15, one of the lowest levels in modern history. Applying a similar ratio to current or projected gold prices can offer insight into silver's potential. For example, if gold were to reach $5,000 per ounce, a figure often cited by analysts as a long-term target, and the gold to silver ratio were to return to 15, silver could theoretically reach $333 per ounce. While such scenarios are speculative, they underscore silver's potential for substantial price appreciation in a favorable market environment. Another interesting metric for assessing silver's value is the silver to average U.S. home price ratio. In 1980, at silver's peak, It took roughly 1,500 ounces of silver to purchase the average U. By contrast, in 2001, when silver was near its historical low of around $4 per ounce, it required approximately 55,000 ounces to buy the same home. Today, with silver prices and home values adjusted, this ratio stands at about 15,000 ounces. If the ratio were to return to its 1,980 low of 1,500 ounces, and assuming the average U.S. home price is $450,000, this would imply a silver price of around $300 per ounce. The convergence of these different valuation models pointing toward a similar price target for silver is striking, suggesting a peak of approximately $300 per ounce could be plausible during a period of extreme market exuberance. However, it is crucial to acknowledge the practical implications of such high prices. A sustained silver price of $300 per ounce could have significant repercussions for industries reliant on silver, such as electronics, solar energy, and medical devices. While such a price might emerge during a speculative mania, it is unlikely to remain at those levels for an extended period without substantial disruptions to industrial usage. Nonetheless, the potential for such peaks underscores the importance of including silver as part of a diversified investment strategy, particularly during periods of economic and monetary uncertainty. This arrangement ensured that oil, a critical global commodity, would be traded exclusively in dollars, thereby creating a constant demand for the currency. However, over the past decade, this dominance has been eroding. Geopolitical tensions, monetary policy decisions, and concerns over the long-term stability of the U.S. economy have prompted many nations to diversify their reserves and reduce their reliance on the dollar. The U.S. has also faced criticism for leveraging its position as the issuer of the world's reserve currency to impose economic sanctions and other measures. While these tools can be effective in the short term, they have driven some nations to seek alternatives to mitigate their exposure to dollar-based risks. This trend is evident in the increasing accumulation of gold by central banks, as well as efforts to establish bilateral trade agreements denominated in other currencies. For investors, these shifts underscore the importance of diversifying away from dollar-denominated assets and considering tangible assets like gold and silver, which hold intrinsic value regardless of the currency environment. The interplay between central bank policies, precious metals, and global monetary trends paints a complex but compelling picture. Gold and silver remain foundational assets for preserving wealth, particularly during times of economic upheaval or structural change. The actions of central banks, the unique properties of silver, and the evolving role of the dollar all point to the enduring relevance of these metals in a rapidly changing world. For individuals and investors, aligning with these trends by incorporating gold and silver into their portfolios is not just a hedge against uncertainty, but a proactive step toward long-term financial security.